Good afternoon, Mr. Valecha. Am I audible?
Yes, good afternoon.
So we'll just wait for another minute before we start. I hope that's okay.
Yeah, that's fine. We'll wait.
Thank you. Normally for the physical meeting, they say about the traffic rush. Here also people need some time to log in and things.
Yeah. Okay.
Okay, I think we are all set to go. So good afternoon, everybody, and good afternoon, Ms. Valecha. And I, on behalf of FEDAI, welcome you all to this monthly discussion series for FEDAI. As you know, we have this, though we name it monthly discussion series, but sometimes miss the target. It may not be actually necessarily having every month. Last month we missed it out because of certain other reasons. I take the blame for that, obviously. And today we are very happy to have you back again. And the topic for today's discussion, as you would have all seen, is the factoring industry in India, an overview. And to give us some better insights into this particular topic, I'm very happy to have today with us and welcome Mr. Ravi Valecha, Chief Executive Officer for India Factoring and Finance Solutions Private Limited. And as many of our members would already be knowing, I think Mr. Ravi is not a new name in the industry, an ex-banker, veteran in the industry, and alumni from Asian Institute of Management, Manila, already have worked in the senior positions in HSBC as well as ICICI, and now managing this very important position as Chief Executive for India Factoring and Finance Solutions Private Limited. And so before I get into the topic, I would request maybe if you can give us a brief introduction about yourself as well, because what I said was maybe too little about the illustrious career what you have in the industry, and also about the India Factoring and Finance Solutions Private Limited, about your company. Maybe if you'd like to share a few words about that.
Thank you, sir, for first of all inviting me on this esteemed webinar from FEDAI. I'm glad to be here and sharing our insights about the factoring industry in India, of course, the market and the various aspects of the business. So my background, you very well mentioned, held some positions in banking and finance across various banks in India, of course, last one being in HSBC, and since then I've been in India Factoring, leading the India Factoring's business on the factoring growth for the Indian markets. The name itself suggests India Factoring and Finance Solutions. We are the specialists in factoring business in India. We are a step-down subsidiary of a bank in Europe, and in India we operate as a non-bank finance company and also an authorized dealer category 3, which enables us to handle international trade transactions, primarily, of course, the factoring business. We are the largest factoring company in India with leadership position since now 8 years, specifically under FCI two-factor mechanism, where we hold around about 62% market share as per the latest statistics. So, export factoring is our forte. Given the size of the market, we believe there is an immense potential in providing factoring services in India, both domestic and exports. And I'm sure that with the several initiatives by the regulators, the industry, and possibly the industry bodies also, we expect the growth of factoring market to be huge in years to come. We have already seen some bits with the Trades being there in India now. Of course, Trades is a more of an online platform as an exchange, but the underlying system with which it operates is under Factoring Regulation Act, and that's what we also operate in. So the growth of the market we do expect, and with that, possibly the broader reach in the markets we will expect. So that's a brief introduction about India factoring in India.
Thanks a lot, and happy to note that the 62% market share, that's really commendable. And one thing which maybe knowing as humble you are, you did mention about that. I think your company has already been always been recognized as the best working place or the most preferred working place. What was that? Continuously for 3 or 4 years, if I'm not mistaken.
No, it's 5 years actually now on the consequent year basis. So 5 years we have been awarded or recognized as a great place to work.
Oh, great place to work. That's really commendable. Something to Tomtov award that, but surprisingly, you didn't mention that. And as you said it right, I think in India, the great economic growth story, what we are witnessing, and the aspiration which we have got for ourselves, especially, I think this year we are likely to touch an export performance of something close to 800 billion, as against if you look at the aspirations, what we have got for ourselves in 2030 is 2 trillion, which is not an easy task, obviously, and we are looking to grow our share in the international trade by many fold from where we are today. And I don't think it's possible without having the proper infrastructure and especially the financing requirements, meeting the financing requirement. As we all know that there's a great financing gap between what the industry require, what the players require, and what the industry today or the banking system is in a position to offer to them. With that thing, and frankly speaking, whatever I know about factoring, whatever whenever I happen to discuss with many of our banker colleagues, especially the people working in the front line, awareness about factoring is very much lacking. People know that factoring is a kind of financing, but if I may ask you, if I can give a little better insights into what exactly is factoring and how does it differ from traditional forms of financing like loans or overdrafts or what we call it pre-shipment credit, post-shipment credit, all sort of things. Because as bankers, we are more used to loans and overdrafts. How is it factoring different from that?
Yeah, so as you rightly mentioned, the awareness levels in India are less or nascent at this stage, and I would not blame anybody. It's a market ways of operating. So, as you talked about the traditional modes of financing banking in India, be it CC, ODs, other trade finance products. Uh, what is the Banking Regulation Act? Possibly 1949 or so. The act itself was in 1949, and that's where it has become in 3 generations, possibly since then, it's become in our DNA that this is how the banking or the loans and advances or the trade finance happens. Now, if you see factoring to that extent, factoring started first of all in India since 1991 with the SBI factors being the first one to be given license. Now, if you see the irony, although factoring companies started in 1991, the Factoring Regulation Act itself came about in 2012. So since then, I would say 13 years or so, I see that a good momentum has been gathered in factoring space. And given the time element, any new such paradigm initiative takes, I wouldn't be surprised that next 10 to 15 years you'll see a huge growth in factoring. Now, how different is factoring is a very basic things. We use the words interchangeably many a times in the banking financial services world is factoring versus bill discounting. Oh, you meet many customers, they also say, oh, it's like a bill discounting. Yes, it is in a structure, you can say a bill discounting, but the underlying legality, which is the most important and the critical factor which differentiates between a bill discounting and factoring is that the legal structure, a bill discounting in any ways or forms or means the legal agreement you have with the banker is a loans agreement, right? A hypothecation or any other agreement. Whereas in case of factoring, you're actually selling of the receivables under the legal term called assignment, which is considered as a true sale. So you are actually hiving off the receivables against a consideration which you receive from the factor or a banker who provides these services. That is the core differentiator. Of course, there are many other aspects also which are different from the bill discounting, but this is the most important differentiator, which many people do not understand. And that's where they end up comparing factoring with bill discounting, end up comparing the cost structure, end up the structure of the facility itself in a different manner. So we are doing our bit to educate the masses, educate the industry, creating in our bit the awareness about what is the other differentiating factors. The the other example I can share with this that bill discounting is a part of a loans other larger facility with the banks which the corporate might be enjoying, be it the CCs, ODs, and possibly other structures. Whereas the factoring is on an independent basis, can be a standalone product also, which is a true sale of the receivables against which you provide. It can be an unsecured basis also, whereas banking facilities typically what we know are secured facilities against collateral or even hypothecation or anything as such. So these two are the differentiators. Then the third element in a factoring, we actually have a connect with the buyer. Okay, so a buyer actually remits the payment to the bank or the factor who's underwriting that risk in a direct mechanism. Whereas in case of a bill discounting, you don't get money from the buyer, you inward remittance, you have access to the customer's working capital account, which you can debit. So this is the differentiator. In factoring, you have a connect, a direct reach. You can follow up with the buyer. The factor takes that responsibility also to follow up with the buyer because you're underwriting that risk. So which is not there in the bill discounting. The structure can be with recourse, without recourse, to the seller in India. So these are some variants. Of course, the very basic variants. Of course, then there are multiple other variants also, which we not touch upon today because there can be at least 20 different variants in different shapes and forms for factoring to operate. When we say without recourse, you're actually underwriting the buyer's risk. So your exposure is on the buyer. You are either underwriting the exposure on the buyer yourself as a factor, or getting it secured or underwritten by somebody called an import factor, which is nothing but a correspondent bank in normal trade terms, who's underwriting or taking that sort of a risk on the buyer because they may have relationship with the buyer in overseas country where they operated. So it's something similar what you call in an LC. It's a transactional basis where the bank on the other side is actually issuing the LC and underwriting that sort of risk. So that's the primary similarity with an LC backed bill discounting versus a factoring product. You're securing your risk. In case of a factoring, it becomes as a limit, a running account basis. It becomes more, running account, whereas LCs predominantly can be on a transactions. The document requirements can be heavy. In case of factoring, that's not the case because you're doing factoring on for open account terms, which is where the global trade is now moving towards more and more. Some estimates say almost 60 to 70% of the global trade is moving towards now open account. So that's the differentiator between, I would say in simple terms, banking facilities, other banking facilities, prime bill discounting, and the factoring. But definitely there are more such activities, and I can go on and spend another hour itself on the differentiators, but let's not go into that now.
Thanks a lot for that very lucid explanation. But I'll just pick a few points from what you have said. You have covered a lot in that. I was just trying to list out what are the points basically which are there. Few things which stood out, and I would like to maybe come back to that. One, you mentioned about that it is still the level of awareness is pretty low, and some of that may be the reasons, various reasons. Obviously, we are not going to discuss about any particular reason, but when you talk about the legal aspects, though maybe the Act came in 2011, which I think was subsequently amended also in 2021.
Yeah.
But surprisingly, when I was just going through the information, I realized that IFG, which is a precursor of FCI, the International Factoring Group, they had a international meeting in Delhi as early as 2013,
Yeah.
which means India has been on the radar for that time. And that meeting was chaired by Deputy Governor RBI, Mr. Chakravarti.
Yes.
And that's in 2013. Maybe just recently the act had come in 2011. And that's the time, as you mentioned, 1991 was the time when SBI factors were set in. Banking Regulation Act was changed, Factoring Act came into play, but still, despite all these efforts and the things, the industry has really not picked up, or it is not been able to exploit or reach to the level where it deserves to be, what is the potential available in the market.
Correct.
So, looking at all these things, I would like to maybe request you to a little bit more on. You talked about that this is hiving of the receivables, which becomes more like with recourse, without recourse kind of thing, which becomes more like a balance sheet management also, besides simply financing and other things. In this context, when we look at India, especially the focus, and so is the globally also, the focus is more on MSME and other thing. And India
Yeah.
also, the contribution of MSME in the overall export performance is pretty high. How are these products relevant in Indian context for MSMEs particularly, and how it can help them manage their working capital requirement for MSME and other thing more than the balance sheet management? It's the working capital, which is more
Correct.
a bigger thing for him.
Correct.
How these things relate, and then along with that, maybe you can also give a little more insights into that, whether it's a with recourse or without recourse, which is a better option for MSME, and how you are addressing those needs, reaching out to the more consumers, more exporters in this field.
Yeah, quite an interesting question. So, a couple of months back, DGFT hosted an interesting, as you rightly mentioned, DGFT has laid down India's trade policy towards 2 trillion exports from India by 2030. 1 trillion of that is going to be merchandise exports. That's the target from around about 778 $800 billion today. The target is huge. And one question the cabinet.
And that I think would comprise of, if you're looking at potential trajectory of the global trade, we are targeting something around 4% plus of the international trade.
Correct, correct. So that's a humongous, aspirational target which is there. Having said so, the cabinet secretary asked that what is required to do and reach those, targets. And one question which he asked is that, for all export requirements, the banks, most of the public sector banks and possibly some private sector banks also ask for ECGC cover, which has become a sort of a requirement, right? And then the next question he asked is that, okay, if that's there already, why do we ask for collateral also? And to that, nobody had an answer, of course, that if you're having an ECGC cover, you're having a risk mitigation, still you ask for collateral. So aren't you securing or doubling your security perspective more rather than the initiative which is there as an MSME finance? On the other side, we have an MSME ministry. It talks about prolonging credit and doing whatnot for the MSME industries. So do these two things are contradictory in its scheme of things itself. So that's where I answered that factoring is that essential bridge. If you are targeting to achieve that 2 trillion, what are we looking at? Enabling finance. Banks want to secure their transactions. How can you secure your transactions? You don't need just an ECGC cover. Possibly you need a counterparty who has a global roadmap. And towards that, we talked about the FCI, structure, which is a two-factor model, wherein the import factor is underwriting risk. You have a trade credit insurance also, which is underwriting risk. What are these? These are credit enhancers for the bank who's underwriting that sort of a risk. So you don't need to rely on the only the financials of the MSME exporter. You don't need the collateral. You derive the strength from the underlying receivable. You back it up securely through the credit insurance or the import factor cover. You have that mitigant in place. You're securing yourself, freeing up the capital for the MSME. So you are winning the situation for the exporter who needs access to finance. You're securing the transaction for the bank. And to the other aspects that the MSMEs can also be prone to default risk from the buyers. So you're securing that angle also. Plus, when we are talking about this being an unsecured and a debt, it's not a debt, it's a sale of receivables. You're strengthening the financials of this MSME customer also. You're pruning their balance sheet, right? the MSME who specialize into manufacturing, whatever it is manufacturing, can focus on those manufacturing aspects rather than being worried about being default risk, rather than being worried about financing, how to finance those things, rather than putting in a person for collections also. So all these activities are actually passed on to the factor for a fee obviously provides these services and also the financing aspects, which enables the MSME to focus on its core strength, which is manufacturing and exports of those services. And when we are talking about reaching a 2 trillion, this I see as a huge credit enhancer, which could enable the MSMEs to grow and increase that business. Because on the back of credit enhancer, the banks can, lend more or offer more services like these to the MSMEs also, whom today they ask for collateral. So these are certain measures which will enable India, if not 2 trillion, definitely, it will enable us to grow in a much, better manner. To lay that parallel, if you see the global trade has been moving, most of the global brands which you talk about in any industry is moving from an LC backed transactions to an open account transactions. Now, obviously, that is the market practice. Now, obviously, seller also wants to secure their transactions, and factoring fits into the exact requirement at that stage. To give you a parallel, something similar happened in China. We all know China since 80s, 90s, when they started their growth engine and how they were able to capture this market on the back of these very services, because they were offering open account terms, they were offering all these credit enablers to the industry in China, who were able to get finance, get de-risk, and provided the mechanism to grow that in that aggressive manner. They also grew at one stage a 2x or a 3x, something what we are also aspiring to. I think the same model can be replicated in India, and the success story can be for the banks and financiers, not only banks and financiers, but I say for the industry in itself, the economy in itself also. You mentioned about some of the differentiators for with recourse and without recourse. Not really too much. When we say with recourse, is that the element of underwriting the buyer risk is not there, and you are taking an exposure on the seller where you have a right to recourse, that in case there is a default by the buyer, you can recourse. However, that said, that is also a sale at the initial stage, but you create a contingent liability in the books. But in case of a without recourse transaction or limited recourse transaction, you're getting a service of credit protection by the factor who's underwriting the risk on the buyer, either directly or through insurer or through the import factor. So this is the primary differentiator which is there between the with recourse and without recourse transactions, which is available in the market today.
Great. I think you have touched upon that China angle as well, how they benefited from all this. And globally, if I see, I think this is more than $1 trillion industry today. The
Yeah.
factoring, if you look totally,
Yeah.
but
Actually, 3
but
trillion.
3 trillion. I think it has been growing in the last 20 years at a pace of 8 to 10% compound CAGR rate. But in India, still, I think it's very small as compared to the overall market size and other things. Any idea about what's the current size and growth potential? Of course, as you have mentioned, we see a great growth potential over there in India. What's the current size of the market in India, basically? I think domestic still is doing something very reasonably good, but cross-border, when you're talking about export factoring, how
Yeah.
big is it?
Yeah, so if you do your math, back of the envelope calculation quickly, $770 billion India's trade. Just do take the DGFT data on industry wise, sector wise. There are certain industries which you cannot do in factoring: long term exports, project exports, heavy industries, possibly oil. Oil and all those things are the domain of the very big banks, MNC banks. That's not the business which a regular factoring can support. So doing all those maths, I come to a number out of $770 billion, a market size of clearly around about $130 billion, also 125, $130 billion as of today, which is an open account and factorable opportunity as of today. As against that, how many, what is the size which all factors, be it us or banks or all put together, are doing it in the number which is being measured, possibly no more than $2 to $3 billion, all put together. So that's a gap of possibly around about 120, $22 billion already being there. Am I saying that $122 billion is not getting serviced? They are getting service. They are going through the traditional means of the banking finance, which is in itself as a loan in somebody's balance sheet. So what is it creating? It is creating a leverage position for the enterprises in India, who's borrowing under regular scheme of trade finance activities, which is bill discounting or in collections or whatever fashion they are doing it. That's considered as a leverage for the enterprise. If that entire $122 billion was to be sold on or factored, imagine the deleveraging, imagine the benefit to the economy it will create, that this much balance sheet is deleveraged. And the enabler being created for all these enterprise, when their deleveraging happens on their balance sheet, their ratios improve, they can focus on expanding their activities. They can focus on their core activities also, right? So this is the market size and market opportunity which is there. And definitely all banks, financial institutions who are able to provide this factoring services, that's an opportunity for them.
So one thing which surprises me is, despite the potential being available, all the benefits and pluses it offers as compared to the traditional bank finance and other things, for both the sides, not only for the consumer but for the banks as well. Because banks are also able to deliver their balance sheet, they may be able to do something, but still the business is not going away from their counter. They are still a
Right.
party to the entire cycle of the trade. Still, it's not picking it up. The reasons which I understand basically, is it because of some kind of, one is lack of awareness, you already mentioned, some kind of misconceptions. The people still believe that factoring is expensive, it's a high risk, and somehow the impression that जिसको और कहीं से नहीं मिलता, they go for the factoring. It's a last resort kind of thing. Which
Yeah.
means if you're going for the factoring, which means you are not considered good for the normal bank finance, etc.
Very important, very important question. There is no one answer to that. There are multiple reasons for that. One, of course, you mentioned upon the awareness. The second aspect is that for banks and financial institutions, it's a very operational driven. You know it. You have been a trade finance practitioner, and you know it that trade finance itself is a very heavy operational requirement. Factoring to that level is possibly 1.5 or 2x more than the regular trade finance activities also. It requires specific tools. The software needs to be there. The skill sets needs to be different than a banking veteran, because the banker sees a risk as a balance sheet risk. Here it is more of a transactional risk. You need to analyze it in a different manner. The other important aspect is also there, is that one is the cost, which from a customer's point of view, definitely the customer sees that it is an increased cost, but they don't see that as a like-to-like comparison. They see a banking cost, a financing cost, a bill discounting cost versus a factoring cost, and they say this is higher. But the services which is being offered by the factoring is possibly 4 to 5x more than just a pure financing. As I said, it's a unsecured finance, it's a de-risking, it's a off balance sheet, it's also providing you collections and ledger management. So all these put together, it's a very, very optimized on the balance cost for the enterprises. That is for the customer's point of view. The other aspect is from the banker's point of view. Also, I mentioned that from the operational and requirements, they need to have a specific software. They need to have a skill set development also, which is also lagging in India. There are programs available by FC Academy, ICC, and various others to do factoring. And factoring requires a specific skill set in assessing, in operational aspects, in selling. All those aspects is available, but not many banks are today investing in these skill sets for their team. The second aspect is also from a regulations point of view. Internationally, if you see, especially the non-recourse factoring, there is capital benefits provided to the banks or factors in global markets, because you are getting a credit risk getting covered on the buyer, either through insurance or through the import factor. For example, our shareholder, which is a bank in Europe, they derive a huge capital benefit as much as possibly 80, for every 100, 80 is a relief provided to them because you have these risk mitigation opportunities. In India, unfortunately, those RW benefits are not provided as yet. Of course, we have been talking to the regulators. I think to an extent, I would say there have been instances in earlier 2000s when things went bad, and that's where the embargo on credit insurance came in actually in 2010 or so, which possibly unsettled the regulators at that scheme of things. But since then, we have crossed multiple levels, right? On the regulation, on the governance, on risk mitigation, even on fraud preventions also. So I think that's an opportunity for the regulators also to step in and provide that credit relief. What will it do is that provide incentive for the banks and factors like us to invest more in these capabilities and provide more finance, which will lower the cost ultimately for the end customer also. So all these put together, and possibly certain things which possibly I'm also not referring to at this point of time, were providing as a deterrent in the industry because the market opportunity size is there. But all these things put together, and last I would say is the easy availability of CCs, ODs, and regular trade finance products. Because for a bank salesperson, which is going to be the easiest revenue because they have KPIs on the revenue what you earn, right? So that's going to be the earlier. If you cannot sell X, you sell Y, you sell Y, A, B, C, D, E, F, G, whatever you want to sell it, you sell and make that KPI of yours, right? Factoring to that matter is a little time consuming because you're going for a buyer to change that account number, right? So it becomes a little difficult situation for the seller to influence that change of account number, or a time element is there. And that's where possibly the resistance that since it is going to take time, you meanwhile take these services in an easier manner. So many things put together has created a lag factor for the factoring opportunity in India to capitalize on that benefit which is there. And I'm sure, the regulator is doing on its bit. The banks are doing their bit also. And the easiest case, theory which I can share with you is that the trades itself is picked up huge numbers. And as expected, possibly this year, this financial year, they are going to cross possibly 150,000 crores, which from 2017 when it was zero, right? So it's a huge growth for by all three exchanges put together they're going to achieve under the Factoring Regulation Act. So the momentum is there, the drive is there, the push is there from all aspects. I'm sure certain more elements of push and drive from all stakeholders will enable the factoring growth from 150,000 crores on trades to possibly much higher numbers for the traditional factoring as well as trades. And now we hear about ITFS platforms in the GIFT City also. That's
right. That's great. I think one that which is a normal human tendency, inertia. Change is always the least
absolutely.
best avoided. Why to change something, as why to work on something unless it's broken, or something which is feeding me, which is taking care of me. Why didn't put in extra efforts? No, when you mentioned it's more operationally more intensive, maybe in the initial stages, and people don't want to spend that kind of time, effort, resources into that. And same time, Trades and the other exchanges also. That's a brilliant success story in India. I think these are some of the few good things which have happened in the recent past. So, how, in your opinion, these digital platform and technologies are going to help us tap the potential available and maybe to make factoring more common and more frequent and better source, or maybe to be able to fill in the gap what is there in the financing and still be in a position to be treated as one of the key products in market rather than just being the laggard as of now what it is, if you look at the total volumes being financed through this particular product.
Indeed, technology is the must in today's scheme of things. All these things changed drastically since 2016 when actually UPI came in. So UPI is a payments thing, but of course the same success story is going to be there in the lending aspects. We are seeing lending being available, digital lending being available. Now, what is the important element in since we are touching upon factoring is, what we need to see is where, how you are going to de-risk your offering. And to that, possibly GST was the biggest change, paradigm change what brought in. With GST today, what does the banker looking at is securing their transactions to prevent against any fraud elements also. So today, the solutions are available to prevent or check those invoices genuinity also through the GST services. You can verify the genuinity of the transaction. So huge mitigation through a digitally enabled blockchain or any other solutions, provide these services today to de-risk the invoice financing for the banks. Similarly, possibly, the end-to-end customer connect, there are solutions now today available where we can connect directly to the customer's ERP solutions. Once they generate an invoice directly, it goes to the factor, and through that the financing happens, and you create a reverse input also, wherein you feed in the reference number of the Swift reference number, MT 103 109 also. All these things are today possible through the digitally enabled capabilities. Exports to that extent may not be end to end digitally capable, because the customer element, the EDPMS and IDPMS, all those connect, the shipping bill. So all this ecosystem today is not available to do an end-to-end seamless financing possibility, because you need to check all these aspects. Then there are other international requirements on AMLs, TF, checks and balances, transaction monitoring, which is required, which is making international trade possibly a step slower than the domestic. Domestic, all these things are happening very seamlessly, and many fintechs you will see are offering these services in a very, very seamless and an optimized manner through digital solutions. International also, there is a huge move. The regulations itself is changing. Then those international regulations on trade finance called MLETR, other aspects are coming in. Of course, as and when India adapts those standards at that point of time, those documentary standards, those all those things will also provide us a huge enabler to move as much as possible to the digitally enabled, which will provide more security, which will provide more convenience to the customer, and a win-win solution for all stakeholders.
I think you touched upon one of the raw now. I keep talking about that India is a leader in the digitization and all these things, banking products and payment products. And when it comes to the international, we are not there in the front. Maybe we are still somewhere, whether we talk about MLETR or digital standardization initiatives or whatever the things. But I'm sure once people like you in the industry are taking note of it, things will improve going forward. One thing, the last I would like to touch upon is that do you see any key regulatory challenges? One you mentioned about maybe the advantage or the benefits in the RWA or the risk strategies or the recognition of the credit insurance, etc., the capital benefit which is there, which I'm sure that there are discussions. I know that there have been in the central bank, Reserve Bank also, there have been some talks, some presentations made by the people about that. But maybe they have their own way of doing things, and for obvious reasons, of course. Are there is something else in terms of regulations, in terms of the government policies, something which can help the growth of this particular industry to make it a little more widespread and better?
No, so from a banker's point of view, I think few of the enablers are these. One of the biggest enabler is going to be the credit in RWA benefits. If a risk mitigation tool provides, that credit enabler is going to be huge benefit for the bankers to get enticed towards offering these products from a banker's point of view. But of course, from other aspects also, there are definitely other aspects, from the regulations point of view, which can create more of an enablers. We are seeing all these enablers being today, if a financier, a factoring company possibly doesn't have those options which a normal banks and banks have easy liquidity from the CASA point of view. To go again, NBFCs, a cap comes to dissuade people from the personal loans. The cap is applied across NBFCs, be it factoring companies, be it MFMIs, or be it so. These differentiators are not there. So that creates not a level playing field for everybody, and that becomes quite a restriction. These refinance tools for the are not easily accessible. We have touching upon all those aspects also to the regulator also. So besides the RWAs, the access to finance, the schemes like treating factoring assets as a PSL assets, that is important. Providing opportunities for securitization or downsell of these assets is important from a distribution point of view. So all these can be a huge enabler and expectations from the regulator, which can possibly change the dynamics of the industry, what we're talking about. From customer sense point of view, like Treds has a huge push through the ministries that, the anchor corporate, the buyer, has to be on the platform, right? So something similar as a, more push from other ministries can enable a deeper reach. It's not just about the turnover, it's about how you are doing business. So all these measures do help, and I'm sure the government and regulators are working their way mechanisms. I talked about also the enablers like I in fact directly mentioned to the DGFT today's scheme of things. Since pandemic, we have been seeing on and off uh, the shipments getting stuck because of non-availability of the cargoes or disruption in the supply chain. So many a times the goods are actually sitting in the port for 15 days, 30 days, or possibly more, and customer is incurring demurrage and a cost. Uh, how about financing it once the goods are handed over to the port? You get an LEO, so that becomes a more like a credit, not credit, possibly a financing, early financing aspect for the corporates. So these are certain arenas which we keep on highlighting to various stakeholders involved. But once the decision comes in, that becomes much easier to provide an early finance and easier finance to the stakeholders in India.
You mentioned about that RWA benefit is access to the financing and also that securitization. Is securitization a common thing for the factor assets in the global market?
Yes, very much. It's a like just like any other trade asset, factoring has become a very, very tradable market, security in the market today. You'd be surprised that in global markets, even funds like mutual funds and various AIFs and others, it has become such an attractive investment class that everybody is investing in these across the world, be it the AIFs of the world or any other fund houses across the world. The reason also very simple, because trade assets typically are short-term cycle, right? At best, possibly a 180 days or so, what we're talking about. So you have the liquidation, and it's a self-liquidation. You're getting money from the buyers, and you're shifting the risk from a seller to the buyer, so you have a larger buyer who's more credit worthy. So from all these perspectives, it becomes a much, much attractive investment class, and there is definitely a market across the world who are doing these funding, be it the fund houses or the various market operators across the world. In global world, there is a huge distribution aspect also. You would be rarely seeing an asset which is the originator actually getting matured with the originator. It could have possibly gone through a multiple leg of transfer at that point of time. I'm sure if you read the initial circulars on trades also, that was supposed to be there. The second phase was expected. Of course, each thing reaches its stage. I am a firm believer that everything happens at the right time, right? So it will happen. I'm sure it will happen. The vision was right, and I'm sure that vision is going to percolate down sometime sooner.
Great. That was really useful, helpful. I think you have covered a lot of ground over there. There is one question which is there. Nisha Rajput has put a question over there. I would leave it to you to answer. I'll read it out for you. She's talking about what are the regulatory reportings for export factors. Now that is the interesting part. The next part is more interesting. Regulatory reporting for export factoring to ensure charge is created on the receivable in India.
So very simple. In fact, the act is very clear in those aspects, because you have the CERSAI, and the act actually stipulates that every charge needs to be created on CERSAI before the transaction starts. So in practice, what happens is the buyer seller combination or at the invoice level, you record these charges with the CERSAI. Now, obviously, the next question, which I can, I understand from the question also, is that what happens to the hypothecation, which is created with the banks. So hypothecation is actually when the receivable is there with the customer and it's a floating charge, so receivables come, go, and all those things. So it's going to be a floating charge on all the receivables. But the moment you sell off the receivables, it is actually the receivable is extinguished from the charge. It is not within the hypothecation. You are selling off that receivables before it goes into your DP calculations or anything as such. So this is the differentiator. And once the charge is created in CERSAI, which is the requirement as per the Factoring Regulation Act, the customer has to remove that invoice details or the buyer details if it is a whole turnover from the DP statements from the which is being given to the banks. So there is a control mechanism also, and that is an obligation on the banks and finance companies to actually see the charge on CERSAI before putting up any other lines on the customer.
Uh, then the next question comes over there to report to Kasai. As you mentioned, we need to report to Kasai. That will need PAN number. But if buyer is not India based, obviously in case of exports, which is unlikely, then how do you take care of this PAN number requirement for that?
So recently, in fact, it is not, it is released. The recently RBI came up with a requirement that for overseas exports factoring, you don't need to register on CERSAI. You don't need to actually do simple reporting also at this point of time. So overseas, because the fields are not there and the details are not there, so you need not do all these things on the export factoring customers.
Okay. And I'll take the next question. In the meanwhile, a message for all our participants. If you have any query, you can also raise your hand. We'll open the mic for you so that you can ask the question directly. Before you ask the question, please introduce yourself and then you can ask the question. We'll have another 5-10 minutes for that. The next one, though it is not relevant in the today's environment, is that as long the interest equalization scheme was there, was factoring also covered under that? Were they also getting the
They
benefit
had
of the
not.
interest?
In fact, that's one of the asks also, which we have made a representation that interest equalization scheme be allowed to factors also.
I hope not to get everybody on the same platform. They are discontinued for the other side also.
Yeah.
Okay, let's see if there is anybody, any hands raised over there. Nothing over there. Then in the meanwhile, I'll take the next one, which is there. Somebody has asked another part to it. Is in India, there are 5.7 crore registered MSMEs. So there is a huge market. What are the key challenges the factoring industry may face in enabling MSME? I think most of the things you have already covered. Would you like to give something more, touch upon something more on that?
No, so there are various schemes, and I'm sure that if MSME in this ministry comes up with those things, I think the financing aspects they have come up with various things like CGT, MSEs, and various other aspects of financing, creating finance opportunities. I think the similar opportunities can be created for factoring becoming a de rigueur product for financing against the receivables because receivable financing, factoring comes up with its specialist understanding and the robust mechanism of financing, whereas the traditional means of banking and finance can be used for expansion, for project finance, for term loans, and various other facilities also. But factoring should be used for anything when it comes to receivables financing.
Okay, now one is that most of the bankers always get worried about in case of factoring, how do you knock off the EDPMS entry? How does it happen? Is there a tripartite agreement? Or how is it taken? It's more to do with the operational part. Is there a tripartite agreement executed between factor, seller, and the buyer?
Yeah,
And
it's the same requirement. It's EDPMS and all those things is the same requirement. What is applicable to AD1 is applicable to AD3 also. In fact, there is another question of depend on AD bank also. So, like us, we are registered NBFC and also an authorized dealer category 3. So we handle the documents ourselves. We are able to, we have our nostro accounts. We do reportings also on a regular basis as it's required by the AD1 and we have access to EDPMS. We have an RAD code also. The customer records RAD code. So all those requirements as is applicable to AD1 is applicable to AD3 and we fulfill all those obligations. We, release the EBRCs also as and when required. So as against a fintech company who may not have access, or an offshore company who's providing factoring in India. They may not have these accesses today. But if you have registered with RBI, regulated by RBI, then you have access to doing all these things today. The EDPMS, the EBRCs, everything, you can do it.
So that leads to something related on that. As a factoring company, do you necessarily need to depend on the AD bank to realize exports through that channel, or can you realize it through your own Nostro account?
Correct? We can do that. As an 83, we are
Hmm.
obligated to provide all those services also. And that's what the key differentiator is.
Right. So it's done through your own Nostro accounts, etc. And then
Correct.
maybe the 81, EDPMS, etc. is with 81. So they will get the message, and through IRM and other things, they'll be able to do it.
Absolutely.
Okay. That makes you a single window for that particular
Correct.
purpose.
Correct. And that's what we call one-stop solution for from India.
Right. Right. And can we do bilateral arrangements instead of only FCI framework? I'm not very sure
See,
what it is.
very important question. And whenever you do, like, you do under financial institutions department of the banks, you do many bilateral agreements. But you have your standard legal terms defined. How do you do a traditional trade finance? You have access to SWIFT. Possibly you follow the UCPs of the world and all those guidelines which is being laid down by the ICC, right? You have the legal backing to it for doing all those arrangements. If you do it on the bilateral basis, you have to create something from ground zero, a bilateral legal aspects of those things. When FCI, an institution like FCI, which is a parallel to, and may not be 100% parallel, but similar to ICC is there, they are giving you the entire legal framework on what you can rely on. So and a history since legacy since 1960s or so when FCI was formed. So you have that many years of legal expertise, the expertise of all banks across the world, possibly 400 odd banks across the world and across 80 odd countries, who's providing you that sort of a framework on which you can piggyback on and use that to channel that agreement between your banker, the import factor who's writing with you. As against that, if you do it completely on a bilateral basis, it's subject to the legal laws, how you frame the agreement and all those things. So benefits are there for both the aspects. It depends on what is the stakeholders, what is your direction from your management, how you want to take it forward. But I sincerely vouch for the FCI framework, because we have had test cases when the legal framework comes in very, very handy.
Obviously, the FCI framework gives you the advantage of standardization and common understanding and common practices rather than going for the bilateral. You need to spend a lot of bandwidth and a lot of resources in drafting each and every agreement,
Correct.
which may not be the.
And now globally, you have this unidroit models and all those things, which is considered by the FCIs of the world, obviously. So all these important legal expertise makes it more uniform across the world.
That's right. That's great. So I think with that we come to the end of this discussion. It was really very interesting and very helpful for me. Of course, I can vouch for it. I'm sure that our participants also would have benefited and gained a lot from that. Thanks a lot, Ravi, for your time, for your efforts, for joining us today, and for sharing your insights and all this, the intricacies about the market, and explaining how is it different, and why is it something which it can offer something great for the industry and the market, which still maybe people are not realizing for various reasons. Maybe there are reasons, sometimes genuine, sometimes maybe something lacking in the industry or something lacking in our effort to put it on that. But I'm convinced, I can see there's a great potential, and hopefully in another year or two down the line, this will be seen as a one more major source of financing for the export and great boost for the exports for the country. Thank you very much for joining us today. Thanks a lot, and
Thank you
thanks
so
to
much.
all our
Glad to be
participants
there.
as well for sharing time.
Thank you.
Thanks. Thank you.
Thank you.